Hi, I'm Jonathan Treussard, and welcome to Treussard Talks, where we talk about the mechanics of investing, the psychology of investing, and what it means to manage your wealth with purpose. Because understanding your wealth shouldn't be as complex as building it. Welcome to today's show. Rob Arnott at McQuarrie. What a fantastic opportunity to talk to you guys. I'm going to intro you quickly, and then we'll get into the topic of the day, which is a really fun and honestly, I think very important paper that you guys just put out recently. But let's start with bios. Rob, you are the founder and chairman of Research Affiliates, where you lead research, product innovation, and strategy. You are a pioneer, possibly the pioneer in the field of smart beta and the developer of the fundamental index approach. You are an unbelievably prolific author and editor, having written 150 articles. You were the editor-in-chief of the Financial Analyst Journal for a period of time. Graham Dodd Awards, ETF Lifetime Achievement Award. You are also my former boss when I worked at Research Affiliates, where I served as partner and head of product management.
And we didn't fire you.
I know, shocking. Well, we got to try again. As of the end of last year, about $150 billion of assets were managed around the world to Research Affiliate strategies. That's you, Rob Arnott. Now, Ed. You are a professor emeritus of marketing at Santa Clara University. You received your PhD in social psychology from the University of Cincinnati. I think the idea that your PhD is in social psychology is very relevant to the topic of the day. You've done a huge amount of research on long-run U.S. stocks and bond returns. You've put together historical data sets that honestly I think the world needed. And you've gotten in the way of some of the runaway narratives around the things, kind of ideas like the stocks for the long run idea and stocks always winning. You've written what I think is important investor-facing kind of advocacy piece almost, where you're trying to educate and inform people so they can make better decisions. And I love that you've been approaching all of that from kind of a plain English kind of standpoint. Now, with those incredible bios behind us, I kind of pick up on the fact that both of you have a certain contrarian approach to research, kind of testing the conventional wisdom. And I'm curious, where does that drive to question consensus come from? Is it personal? Are there mentors and stories behind it? Rob, maybe you go first.
Sure. All my life, I've been curious. And I think my competitive advantage in my career has been that I don't anchor on this is how the world works. Don't show me any evidence to the contrary. My approach has been, how does the world work? And when somebody tells me the world works in XYZ fashion, I will pose the question, gosh, has somebody tested that? Sometimes the answer is yes. Often the answer is no. And if they haven't tested it, then what we're talking about is a belief system, not science. Scientific method involves starting with a hypothesis, testing it, and ideally finding the flaws in your own ideas before somebody else does, being willing to stress test your ideas. So it's just been central to who I am. I don't anchor on things as fact. During the whole COVID mess, I was just beside myself with annoyance at all this follow the science stuff, because science is about testing alternative hypotheses and not anchoring on a particular belief. It just drove me nuts that they were calling that science. So I find the whole process of learning about how the world works to be just wonderful fun.
At you, Ed, what's the drive?
I'm a troublemaker, Jonathan. It's a personality thing. It's kind of been, as Rob mentioned, it goes way, way back for me. I've always been an outsider. And, of course, the only feasible role for an outsider is to challenge.
It seems like we're three troublemakers, so let's make good trouble together. You wrote a piece recently, which is now out for people to read on SSRN, and I'm sure you're going to be published very soon. And you kind of tap into this concept. And again, I think, Rob, it goes right to the center of actually trying to understand how things work as opposed to taking them on faith, which is what's driving stock returns for the long run and what's the real rationale for, when people talk about stocks and investing in the stock market and they want to sound smart, they say things in passing like, well, stocks go up and to the right over the long run. And that may have been true, though there's a question about using the present tense because that makes it sound awfully scientific. But very quickly you say, tell me more about why, right? And the first mumble is probably some version of something about capitalism. And then the second mumble is probably something having to do with risk. And I think we can all agree on the capitalism bit being the one driver we have to pull this whole train forward. But tell me about risk versus fear and the central thesis of the paper you just released.
Well, I've long had a view that the risk premium, the notion that if we take on added risk, we're entitled to added return, has things a little backwards. If we earn a premium return, we probably took on added risk, but the opposite doesn't necessarily hold true. And what drew me to work with Ed on this is his paper that challenged the whole thesis of stocks for the long run in the Financial Analyst Journal. It was winner of Graham and Dodd recognition as one of the best, if not the best paper of the year. And what he did was a painstaking job of tracking down data from the 19th century and early 20th century on how stocks and bonds performed. Now, the narrative of stocks for the long run is if you take on the added risk, you're going to get the added return. You got to be patient because there can be periods of time when it disappoints. That's the nature of risk. But over a span long enough to be still useful over the course of a human lifetime or career, you're going to win with stocks. That's the narrative. We find that if you started in 1950, yeah, stocks for the long run, but you had this lost decade. You had this lost decade. But each of the lost decades, you were back in the black, well ahead of the bond investor. And boy, you started at a little under 4, you finish at around 200. That means you made 50 times your money as much if you were a stock investor as a bond investor. Good gracious. That's a span roughly as long as a human lifespan, but still take any reasonable chunk of it and you're looking good. And Ed took data all the way back to 1803 and found, gosh, the 19th century was a century with no risk premium. Most of us don't have a 100-year lifespan. So something's wrong with the whole notion. And the funny thing is, this half century from 1950 to 2000 was a period of time when stocks started with a dividend yield of 8% and finished with a dividend yield of 1%. So an entire quadrupling. There have been 2.5 quadruplings over this span. 1.5 of the 2.5 quadruplings was purely a function of stocks' dividend yields tumbling and valuation multiples rising. So this is beautiful work, Ed.
Thank you, Rob.
And Ed, this is why the data are so important, right? Which is we all go off of our lived experience and we assume that it becomes scientific truth.
Yeah, let me pick up on what Rob mentioned about risk and risk premiums, because that really is at the heart of the challenge of the current paper. And building on what Rob said, a mindset has grown up ever since Jeremy Siegel published Stocks for the Long Run 30 years ago, that, when you buy stocks, you take a risk. And since you took a risk, you're entitled to a higher return. And before I get to working with Rob on the current paper, and I'm writing the conclusion to the FAJ paper, and I'm saying, absent the 19th century data, there's rather a conundrum, okay? Stocks go up more than bonds because they're riskier than bonds. But if stocks always go up more than bonds, where's the risk? And if there's no risk, why should stocks go up more than bonds? Okay, so it's a conundrum. I mean, no rational person would take a risk without some prospect for reward. And that's fine at the prospect level. But to have risk never show up, just hold on for 20 years, everything gonna be fine. Well, that's a conundrum. I mean, where's the risk if everything's going to be fine as long as the investor is patient? And so the first solution to that conundrum was the 19th century data that I got. And I don't think it's going to be relevant here on this podcast, but we can drill down as to why it's different and how it's different than what people believed before I came on the scene. But the first solution was simply, sometimes there was no equity premium, like the first 100 years of the market. Well, now risk has shown back up and there can be a risk premium. The second solution, which is the current paper that we're talking about today, fear, not risk, explains asset pricing, is that this whole discussion of risk as the driving force on stock returns is simply misguided.
Yes.
So that's interesting. And Ed, I'd love to hear the short version on the 19th century, but it points to the fact that the 20th century and so far the 21st century has really been a lucky draw. Would you describe that as a reasonable shorthand version of what the data are telling you?
I think it's fair. And the polysyllabic version is investment returns have not been stationary. 20th century, it really was great. Okay. And so far the 21st century, not so shabby. The 19th century, different draw, not so good. And so again, there's this notion that a risk premium can't be guaranteed. That's not risk. Okay. Whereas centuries are all over the map. If even 100 years doesn't, as it were, produce mean reversion, then there is risk. You don't know what's going to happen.
Bill Sharpe won a amply deserved Nobel Prize for co-creating the capital asset pricing model, which basically says that your expected return should be linearly related to your non-diversifiable risk, which is called beta in our business. The risk that can be diversified away. Got a high volatility stock, another high volatility stock, they march to their own independent drummers, put the two of them together, and you got the same expected return as you would for each of them, but you have 30% less risk because they're uncorrelated. Okay, well, that's nice. Harry Markowitz famously said through much of his career that diversification is the only free lunch in investing. And so the idea of diversifying has merit. But his notion that non-diversifiable risk is linearly related to reasonably expected future returns ignores a very core element of human nature, and that is we all hate downside risk. If you've got $100 and it goes to $50, you're not happy about it. And none of us is afraid of upside risk. If you've got $100 and it goes to $150, nobody's disappointed in that. And so the way Ed and I sorted this out was to recognize that objective measures of risk tacitly imply that you're equally afraid of losing money and gaining money, which is stupid. The academic community has known that it's stupid ever since the dawn of risk theory. Now, why do they cling to this? They cling to this because the mathematics is very tractable and not terribly difficult. And if you segregate upside and downside risk and say, well, as a human being, I hate downside risk and I love upside risk, the bigger the better. And it goes beyond that. I'm actually terrified of missing upside by being so afraid of downside that I miss upside. Then tacitly, fear is the driver, fear of loss versus fear of missing out. Now, where it gets really interesting is when you're looking at a market cycle, well into a bear market, people are terrified of additional loss, and fear of missing out isn't that great. You really don't want further loss. And during a growth-dominated, long-lasting bull market, people get less and less and less fearful of loss, and more and more fearful of missing out. So to the extent that you can independently measure the two independent risks, the risk of loss and the risk of missing gain, if you can independently measure those risks, then you can actually have a gauge of whether the risk premium classically defined might actually be negative because people are more afraid of missing out than of downside risk, and therefore may have an appetite for risk where they will pay a premium, and accepting a negative expected return in order to not have to worry about the fear of missing out. In some ways, it's the same driver for the lottery conundrum. I mean, no rational person should want to invest $1 for a 1,000,000,000 to 1 chance of making $1 million.
You know, it's interesting how you describe it. Let's just call it behavioral finance and prospect theory.
Right.
And it has some aspects to that, but it deviates, right? What we know from prospect theory is that people are risk averse in the gain part of the distribution, of course, in the risk seeking and the loss part of the distribution. But the way to actually describe that is when you feel like you're behind the 8 ball, when you feel like a loss is on the menu, you'll go out of your way to gamble your way out of a loss. Mm-hmm. And of course, when you're in the gain zone, you're saying, no, give me the certain gain, right? So in a weird way, this creates what you guys are doing, to me, feels like a dynamic mapping to prospect theory, where there are parts of the cycle where people are pursuing gains, and there are parts of the cycle where people are just desperately trying to avoid losses.
Jonathan, if I can map onto that prospect theory discussion, and this is not yet in the current paper because I hadn't thought of it. Your listeners will probably be relatively familiar with that key prospect theory chart. The utility curve is kinked. And that's, as Rob put it, we're a lot more averse to losing $50 than we are attracted to gaining $50. You can think of fear of missing out as one further adaptation of the utility curve. Under prospect theory, we have a downward kink. Losses are peculiarly painful. Under a fear theory, we add a second upward. The prospect for really big gains, skew, as we call it, is very especially attractive. So in a revision, we may try to redraw the prospect theory curve with 2 kinks, one on the downside and one on the upside, and call that our representation of fear theory.
I love it. If I were in the meme-making business, I feel like it would be one of those cartoons from the olden days with the wolf that's drooling and just can't wait to get their hands on the upside. So I get all of that. And the other thing that I want to hear your thoughts on is how this maps to the concept of the equity risk premium and the fact that the basic construct of risk aversion just doesn't cut it, but also how that relates to factor investing, things like value investing and all the other members of the factor family.
Rob, that's got to be you.
Why don't you talk about it while I find the graph that I think is really cool?
Okay. So basically, the notion is that under risk theory, there can be no factor effects. There can be no value effect. There can be no size effect. None of the zoo makes sense because basically it would simply be, well, sure, riskier stocks, which you happen to label as value stocks, they can outperform. But if the data shows that the value factor or the size factor does not have a higher standard deviation than the market itself, then there's no good explanation under risk theory for why the value factor should produce performance. Whereas, under a fear theory, if we introduce fear of missing out, boy, I found a big bargain here, this baby's going to zoom, well, then we can get a value premium, in fact, in a way independent of risk.
How does that compare to what I would describe as fear of looking stupid and alone, right?
Ooh.
Because a huge part of the psychology of markets is not just your own, but there is a social component to it, right?
Now, that's very interesting, Jonathan. You just paid for my time on the podcast here. I like this.
Oh, good.
The fear of looking stupid. I hadn't formulated FOLS. I'm going to have to reflect on that for a little bit. But while I take time to do that, let's go to Rob's chart.
Thanks for listening. I'm Jonathan Treussard, founder of Treussard Capital Management. I hope you're enjoying this episode. If you'd like to start receiving my free newsletter, Wealth Empowered, or if you'd like to learn more about me and Treussard Capital Management, go to Treussard.com. That's TREUSSARD.com. Thanks, and enjoy the rest of the episode.
This rather strange-looking graph shows the annualized return over various spans. The black line traces really the last century, 1926 to 2024. The red is the first third of that. The blue is the second third of that. The green is the third of that. This is the recent span that we all know reasonably well. And the starting point for these lines is stocks that are large growth going to stocks that are large value going to stocks that are small value. So the general perception is small is riskier than large. Value is riskier than growth. Growth companies have wonderful prospects. Everybody's happy to own NVIDIA. Nobody wants to own a company whose prospects are doubtful or who's shrinking or whatever. And large is safer than small. And so these companies are the safest investments you can buy. These are riskier. And sure enough, the risk goes up. You're going from a 16% volatility to a 20% volatility. And as you go to small value, you're going to 22% volatility. Now, the other part of it is this dot is small growth, which means higher risk, and value growth, which means lower risk, should kind of cancel, should have similar risk. And lo and behold, the risk is actually the highest of the bunch. And you should be getting rewarded for that seeming added risk associated with being in small growth companies versus large growth companies. But no, you're getting much less return. Instead of 11%, you're getting 7%. That's a huge difference. So all of these should look sort of like the red lines where you go from large growth to large value, you've got higher risk and higher return. You go from large value to small value, you get higher risk and higher return. You go from large growth to small growth, higher risk, not higher return, but at least it's not lower. So this sort of looks right from a factor perspective. You're taking on more risk. Objectively, it proves out the risk is higher, and you're getting more return for it, which is as it should be. All right, finance theory really grew up in the decades following this red line. In fact, capital asset pricing model was invented in 1964. If you look at Jack Trainor's work, it's 62, but it was unpublished. But early 60s, and this ends in 1958. So people looking at this data would say, oh yeah, that kind of ratifies what I thought, that higher risk would mean higher return. Then you come to the next 33 years and you find perceived higher risk, nope, it's lower risk, but higher return. Perceived higher risk, yep, higher risk and higher return. Perceived higher risk, yep, higher risk, but no higher return. Perceived higher risk, no, lower risk and higher return. Anytime you have an upward sloping line to the right, it's going the right direction. Anytime it's not upward to the right, this is downward to the right, this is upward to the left, it's wrong. This is upward to the left, it's wrong. 3 of the 4 lines are wrong. If you look at the full century, you find this line is right on both counts. This line is right. This line is wrong. So you have a century in which the large growth to small growth comparison has the wrong reward trade-off. You're getting 100 basis points a year less return while taking on a 50% increase in volatility. And so the point of this exhibit is that empirically, the relationships that drive risk theory, that drive capital asset pricing model simply are wrong.
Yeah, and again, it really speaks to this concept of lived experience, right? Which is the people that were building the theory really were just reflecting the short-term experiences of themselves, of the people around them, assuming they were young, academics at the time. And so that's the curse of our experience of the world. It's just limited to what we've lived through. I love the characteristics you put forward on fear. Omnidirectional, social, irrational. We talked about time varying. Can you spell out a little bit more? I love irrational. That's fabulous. And omnidirectional too, because as I said, we can be afraid of anything and possibly everything all at once.
Let me take a stab at that. So irrational, is of course our attempt to distinguish ourselves a little bit from the behavioral finance mainstream. I mean, we could not be doing what we did without the conceptual underlayment. But where I think behavioral finance might have gotten trapped in a cul-de-sac was the initial impulse to say, silly economist, investors are not rational, they are irrational. Okay, and then that debate kind of fizzled out after a decade or two. Victor Haghani's riposte was something along the lines of, well, regardless of what investors are, the positive theory, let's talk the normative theory. Should investors be rational? Yes, of course they should. So we end up with these two camps. Investors are rational, investors are irrational. I stuck that word irrational in there because, you're a hiker. You're coming around a curve here in Southern California, and you hear a rattle up ahead. Fear is a completely rational response. On the other hand, we can imagine all kinds of, we'll put ourselves in a city filled with people that look different than ourselves, and we can imagine all kinds of irrational fears. So fear in our telling, fear is not an emotion. Fear is not an irrational, pitifully human response. Fear is aversion, okay? And before we came along, everybody knew about risk aversion, and aversion was unidirectional. We simply made aversion omnidirectional. I'm averse to losing money, and I'm averse to leaving a big pile of chips on the table. And aversion drives behavior around money. Because money is a dead thing. There's no life in money. So money is about fear. It's all the different things that can go wrong with your money. You can lose it, or you can't ever make any of it. Fear, fear, fear.
I think part of the motivation behind this paper is, for me at least, a sense of deep frustration. Capital asset pricing model was invented 60 years ago, laid the foundation for the whole notion of risk premium, which predates CAPM, but became accepted dogma in the decades that followed. I briefly served as a professor at UCLA in the business school in 02 and 03. I was kind of giving back because I graduated from the UC system. And I remember a professor from Harvard was interviewing for a tenure track job at UCLA, and she came in and gave a presentation, and she opened by saying, if the market is inefficient, what kinds of inefficiency would be expected? And there was this chorus among the professors. There are at least 3 professors who simultaneously said, but the market is efficient. I thought, okay, blinders coming down on their eyes. They're not going to listen to the rest of the presentation. To me, the essential purpose of the paper is to encourage the academic community to take something that they know is false, the notion that aversion to downside risk and aversion to upside risk cannot possibly be the same. There is no human way that we're as averse to get profits as to losses. And everybody knows this, and yet they all stick to that as the key driver. Why? I would argue because the mathematics is more tractable and easier, and it just makes the whole thing so much simpler. So let's please stay with this basic theory that we know is wrong, but maybe we can get something useful out of it. Come on, stop it.
That's right. It reminds me of something that I think Paul Samuelson used to say, which is elegance is for tailors. And, there is too much of that in the modeling world, right? Oh, it's elegant, as if that wins you points, right? As opposed to this is actually helpful. And I think you're right, Rob. I think the academic circles are guilty of that. And some of it is laziness. Some of it is the incentive to please the people that came before you. And of course, they had, those assumptions in the papers, which is why I give so much credit to the people that are willing to steer in a different direction. And the other part is, in a lot of ways, this has been, and this is somewhat conspiratorial, but I would say it's been good enough for the industry. And what I mean by that is particularly people like Rob, people like me, people that are in the business of actually staring markets in the face and making investment decisions know this to be incomplete, know this to be inaccurate. But in a lot of ways, the mean variance model has been a perfect excuse for, let's just call it, selling mutual funds for the last 60 years. You shove anything that doesn't have a perfect correlation in the model, you get a quote unquote recommended allocation, and you can unleash your salespeople saying, see the model. It's just kind of intellectually cheap all around, which is why I think this work is so beautiful and important. Tell me more about some of the practical implications for setting expectations, right? Abandoning stocks for the long run as a certainty. There is no such thing as that being a certainty. Recognizing that equity premia and factor premia can disappear for decades, and it doesn't make them wrong. It doesn't make them off the mark. It's just the nature of dynamics in the market. The kind of incredible run that we've had since the 50s really being on the back of PE expansion, and as a result, not necessarily being overly predictive of the future. But now, how do you think about practical implications when it comes to portfolio construction on one side of it and client communication? How do we educate investors to actually take these lessons forward and be more prepared?
So moving now to practical implications, consider the target date retirement fund. Now the default investment legally for millions, tens of millions of U.S. investors. The target date fund is a perfect creature of Markovitzian risk theory. Let me explain. When you combine stocks and bonds, and say in the Vanguard case, it's international stocks and domestic stocks, it's international bonds and domestic bonds, you've got thousands and thousands of uncorrelated individual securities all within this wrapper. And the standard deviation of that mix is driven down. So in a Markovitzian perspective, standard deviation is the definition of disutility. People are averse to volatility. We've given them this huge mix of index funds, which will drive volatility just about as far down as you can. And so it's perfectly appropriate within a Markovitzian scheme. Now, once you introduce fear of loss rather than fear of standard deviation, you've got a problem with the target date fund. And the solution to the problem is to go back to Tobin, okay? Put Markowitz aside, everything's an asset, mix them together, you're on the efficient frontier, okay? Tobin is the two-fund theory. One fund is the cannot lose money fund. He called it risk-free, but that got mixed up with the Treasury bill, which eventually started yielding 2 basis points per year. So if investors are fearful of losing money, some portion of their funds needs to go into a fund that can't lose money, okay? But the other portion of their funds goes into the risk portfolio at market weights. You own all the risk assets. We're back to Sharpe in that respect. But you have separation. So if you lose your job at 46 while the stock market goes down, target date fund's not going to help you that much. But if you had a separate fund that does not lose money, you get something to keep you going until you get that next job.
Now that you've brought up TDFs, I'm afraid we have to go there. I wrote a piece with Tzvi Bodhi back in 2006 as TDFs were getting broadly accepted, basically making the point that TDFs are optimal for nobody and trying to measure the loss relative to what that meant. But a couple of things. One is I'll introduce a new fear for you. As you may recall, I talked about the fear of looking stupid. You know what might be worse than the fear of looking stupid? The fear of getting sued. And that really has been driving a lot of the adoption in target date funds. The moment you became a safe harbor, it was giddy up. So I think that's really important. The other thing, and again, this is related to exactly what you were describing. Tzvi Bodhi wrote Worry-Free Investing 1,000,000 years ago, which was advocating for basically creating a floor using tips and taking upside with the rest. I think that's very aligned with what you're describing. Larry Kotlikoff has tried to kind of create planning models around it. By the way, my first job while I was still in grad school, Bob Merton had launched integrated finance, and we were trying to create a product called SmartNest that was supposed to be doing that in a DC format. And you know what? No one wanted to adopt the thing. Why? Because it was deviating from the one thing that wouldn't get you sued.
Oh, dear.
Right?
Oh, dear.
I was invited by CEBA, which is the group for employee benefit funds for large corporations. So all of the biggest pension funds, corporate pension funds in the United States were there. I was invited to speak in 2001 on what the quantitative world had delivered and what it might deliver in the future. I did speak about defined contribution plans, which were moving in the direction of what they then called glide path strategies and now call target date funds. And I said, you know, you're marketing this to your employees as if it will deliver an 8% return with modest risk. And I said, from today's yields, stocks were yielding 1 and change, bonds were yielding about 6. I said, from today's yields, you're likely to deliver with a balanced portfolio something on the order of a 2 or 3% real return. And if inflation is 2, that's 4 or 5%. I said, don't think that the defined contribution market is immune to lawsuits. And the general reaction was, oh, come on. That's why we're getting out of defined benefit, because we're getting sued left and right on defined benefit and not giving people freedom. And if we do the 401ks and IRAs, we give them the freedom and simply offer them guidance to do what's boring and conventional. And there's no way of getting sued. Kind of a crazy reaction. I'm going to go back to one of the exhibits that we were looking at earlier and draw attention to how a lot of this can interrelate with the right way to invest. Back here, you had dividend yields for stocks of 8%. Bond yields were 2%. If stocks had 6% negative growth in earnings and dividends, they would still match bond returns. The risk premium classically defined was enormous because people had just been through a Great Depression and a war. And risk, you had risk, huge risk, massive volatility, and people demanded that they get rewarded. This was a point in time when fear of loss was huge and fear of missing out barely existed. The notion of, oh, yeah, I can double my money in stocks. Yeah, but I can also get wiped out. Give me a break. I'm not that interested in the risk. Here, you were looking at a 1% yield for stocks and a 4% yield for TIPS, inflation-linked bonds. That meant that if stocks had earnings and dividend growth of CPI plus 3% above the rate of inflation, they would just match government-guaranteed inflation-linked bonds. I wrote a paper in early 2000, Death of the Risk Premium, in which I pointed this out and said from today's levels, we're in a period of a negative risk premium. I hadn't yet framed it in terms of we're in a period where fear of missing out on more of this, fear of missing out, utterly swamps fear of loss. But that's another way to put it. The risk premium was negative. And it was negative because fear of loss was minimal and fear of missing out was huge. So people were happy to embrace the lottery ticket mindset of I'll take low odds of an enormous gain and accept downside risk because I don't think the downside risk is there. I've never lost money since the early 80s. How soon we forget. This is a 22-year span, 2000 to 2022, where long treasury bonds beat stocks. That's 3 years ago. How many people today think of stocks as having so much downside risk that you could go 22 years being behind the bond investor? And what wipes that off of the slate for most investors is that the lion's share of their career, unless you're a reasonably old fart, is this run, just like it was this run and this run. And so you have this constant reinforcement of risk premium, risk premium, risk premium. Buy stocks because they're going to give you a risk premium. When in point of fact, the relative returns are just a matter of what's the difference in yield and what's the difference in growth rates. I like using TIPS, as you and Zvi did, as the comparator to stocks because both have inflation pass-through. But stocks yield 1, TIPS yield 2.5. That's a 1.5% spread. Stocks have to have growth over and above inflation of 1.5% just to match the bonds, let alone to provide a premium. And yet today, the general consensus is, who cares about the risk premium? Stocks are always going to win. Human beings are malleable and are deeply linked in with what their recent experience has been. This is a sextupling of wealth in the space of 15 years. That's a lot.
No, I think that's right. And so fear is irrational. It's not irrational or rational, but the reality of fear is very clearly that it's moved by experience. It's moved by, let's just call it marketing, whether it's academic marketing or otherwise, stocks for the long run. And that's why I so completely hope that academia embraces your paradigm, that the industry recognizes that in a world where we're supposed to be doing this for the benefit of investors, as I remember the mission statement from my research affiliates days, part of it is educating, not shying away from uncomfortable truths, and trying to navigate the people that have trusted us with their capital through very complicated circumstances. So I really applaud you, and I can't wait to see the final product of this paper, the future research, all of that. Now, before we close, Rob knows this about me. I'm a Frenchman. I grew up right outside of Paris, and I was bathed in French TV. And one of the shows that I would watch with my grandparents was a culture show by Bernard Pivot. And he asked a series of questions to every one of his guests. And the same series of questions was then adapted by James Lipton for the US TV show, The Actor Studio. So I'd like to go through a short, quick-fire set of questions, and we'll take them one at a time. You guys can go back and forth who goes first, and you can be as explicit as you want to be or as metaphysical as you want to be with the answers. What is your favorite word? Rob, do you want to go first?
Favorite word? Autochthonous.
Oh boy, I'm going to need a dictionary.
Yeah, because it's a word that shouldn't exist. It has CHTHONUS in the spelling. And how can you have CHTH? Basically means native.
Homegrown, if you will, kind of thing. Favorite word these days, I think it's non-stationarity for our discussion before.
Mm-hmm.
Love it. Least favorite word? Ed?
Everyone knows. Sorry, it's 2 words, but it is my answer.
Like. Everyone, like, can't help but, like, put, like, into every, like.
This is where I'm going to encourage you to be as metaphysical as you see the need to be. What is your favorite drug?
Fine French wine.
Like it.
The blank page on Monday morning.
What is a sound or a noise you love?
Led Zeppelin.
I have central auditory processing disorder, so I'm not sure I love any word or sound. I'll answer this way. The sound of a rhyme.
What is a sound or a noise you hate?
I've been to drag racing occasionally, and the sound of a 0 to 300 miles an hour in 3 seconds car is rather jarring.
For me, this goes back to my youth when I wasn't living in a fine coastal house, but in an apartment just like any normal person. My least favorite sound is the noise of a TV coming from next door.
Oh, I could see that. What is your favorite curse word?
Sorry, on the advice of counsel, I refuse to answer.
It's a curse word.
Who would you like to see on a new banknote?
My favorite president, who is widely dismissed today as boring and irrelevant, Calvin Coolidge.
I'll go with Franklin Roosevelt.
What profession, other than your own, would you never, ever want to attempt?
Wingsuit diving.
If that's a profession, I'd like to see people get paid to do that.
My answer would be giving investment advice.
If you were reincarnated as a plant or an animal, what would it be?
Your turn, Ed.
A panther cub.
I'll go with bougainvillea. Nice, boring lifestyle.
I like it. All right, last one. Are you guys ready? If heaven exists, what would you like to hear God say when you arrive at the pearly gates?
How the F did you get here?
Take line 1 over here.
Wonderful. Well, it was a fabulous conversation on a very important topic. And again, I think one that will shape the way we think about markets and hopefully informs the way we behave around markets for decades to come. So thanks to you both.
Thanks to you, Jonathan.
I want to thank you for the years you worked for us. It was a real pleasure working for you. You are a gentleman, a scholar, and just a wonderful human being. And it's wonderful that we've been able to stay in touch. Thank you.
The gratitude goes the other direction.
A longer thank you, Jonathan. Your listeners may not be aware that you played a crucial role in the genesis of this fear paper. It was something that you wrote while we were kicking around. You know, Rob has this great idea about fear. What can we do with it? Where can it go? And it was something that you wrote that was actually the proximal stimulus to the first draft of something I wrote that later became part of what's up there on SSR today. So thank you, Jonathan.
Well, it was my real pleasure. And again, anything I can do to move the ball forward, I'm always happy to do.
All right.
Thanks to you
Take
guys.
care.
This podcast is for entertainment and education only. Nothing here is financial advice. Treussard Capital Management is a registered investment advisor. Please visit our website, www.treussard.com, for additional information and disclaimers.